All right, Christy, should we get started then?
Absolutely, would love to.
Okay. All right, guys, thank you for joining. I'm going to share my screen with you. Let me see. Okay, hope you guys can see my screen and hear me clearly. So yeah, for the next half an hour or so, I'm going to walk you through some of the important things that you need to know about crypto taxes, tax saving tips and tricks, and what you need to do to stay out of the IRS trouble. If you guys have any questions, we're going to have more than 30 minutes or so. So I'm happy to answer those things. Make sure you send them through Zoom so I can answer those questions. So quick introduction to me. Oh, by the way, Christy and she256, thank you very much for this opportunity. Really happy to be here. Quick introduction to me. So I'm a CPA. I'm a head of tax strategy at a company called CoinTracker, which we help people calculate their cryptocurrency taxes and help them save on taxes as well. The easiest way to find me is on Twitter. I'm pretty active there, maybe too active. It's at the Crypto CPA. Okay, so objectives. We're going to cover three things. I'm going to give you a quick overview of crypto taxes, how they work. And then secondly, I'm going to talk about some tax saving opportunities. And finally, I'm going to tell you how tax software can help you remove your headache. Disclaimer, tax laws are extremely complicated. This Zoom session is purely educational in nature. If you have any specific questions, I encourage you to hire your own tax professional. Okay, so with that said, let's just move on to the presentation. Again, I'm not going to go through all these milestones here, because if you guys are in the crypto space, you guys are already familiar with the gray area. The Bitcoin came into circulation around 2009, 2010, and over time it gained so much value. But when it comes to taxes, what's important is the time period starting from 2014. So 2014 is the first time that the IRS came in and said that cryptocurrencies are taxed, and they are taxed as property. It's very similar to stocks and security transactions. So you have a purchase price, you have a sales price. If you make a profit, you pay capital gain taxes. So 2014 was the first time the IRS came out with guidance. And during that time period, we saw 2019 IRS issued frequently asked questions around cryptocurrency, explaining airdrops and hard forks and etc. And then the last year, IRS included that virtual currency question on Schedule 1. And then this year, the big news is that somehow this crypto, which was once a niche subject, at least in the tax point of view, it made all the way to the front of the Form 1040, which goes to roughly 150 million taxpayers in the US. So the question pretty much asked at any time during 2020, did you receive, sell, send, exchange, or otherwise accrue any financial interest in virtual currency? It's a simple yes and no question. If you go to TurboTax, or if you are using an accountant, this is a question that you're going to come across this year. And if you're in the crypto space, make sure you answer this question correctly. Something to keep in mind is that just because you answer yes for this question doesn't necessarily mean that you're going to get an audited letter by the IRS tomorrow. The purpose of IRS adding this question here is to increase US crypto tax compliance, because it has been very, very poor historically. So by adding this question, IRS is signaling people that they really care about this space, and people need to report crypto taxes. So speaking of taxation, so these are the three authoritative guidance that have been issued by the IRS. These are publicly available. You can Google them. I'll also share the slides with you as well, because the slides are linked. 2014-21, 46 FAQs, and there was a revenue ruling called 2019-24. Again, the high-level takeaway here is that cryptocurrencies are treated as property. Even though we call it a currency, all cryptocurrencies at the moment are treated as property according to the IRS. So what this means is that whenever you sell a cryptocurrency, for example, there's a difference between the sales price and the purchase price, and that profit gets taxed. So that's the simple way for you guys to kind of think about the taxes. Now, we know that cryptocurrencies are subject to taxes. And then the next natural question is, when do you owe crypto taxes? So these are the 5 situations where you would be subject to crypto tax implications. So let's go through this one by one. Number one is when you sell your crypto into fiat. Pretty self-explanatory. Say you got a Bitcoin for 10,000 bucks, you sold it for 50,000 cash, and you got to pay capital gain taxes on $40,000. Number two is somewhat not super clear for most people. This is a situation where you exchange one cryptocurrency to another. Say you spend Ethereum and bought Bitcoin or something else. And if you have a profit, you still got to pay taxes, and the IRS doesn't really care whether you received cash or not. So something to keep in mind, because a lot of people who are in this space are doing crypto to crypto trades, not realizing that those are triggering taxes as well. Number three is when you spend crypto to buy, goods and services. You could be buying a subscription by paying Bitcoin, or you could be buying a cup of coffee. Those are subject to taxes as well, because crypto is not a currency. You're spending a property. Number four is when you earn cryptocurrencies. So you could be earning cryptocurrencies through wages, mining income, staking income, DeFi income, interest income. Those types of income are subject to taxes at the time you receive it. Again, IRS doesn't really care whether you receive cash or not. At the time you increase your wealth by receiving that crypto, you have a taxable event. And finally, if you go through like an airdrop or a hard fork, that newly received coin creates a taxable event for you. It doesn't matter whether you needed that coin or not. As soon as you receive it, that generally triggers a taxable event. So these are the 5 situations that you need to remember. And if you have these situations, most likely you have a reportable transaction where you have to file additional forms with the IRS. Now, those are the taxable situations. Now, the next question is what kind of taxes that those gains are subject to. So in the tax code, there's primarily 2 types of taxes, ordinary income taxes and capital gain taxes. So ordinary income taxes, these are the tax rates where you're W-2, or like if you're like an employee, you pay ordinary income taxes based on your tax bracket, as you can see on the left-hand side of the slide. Now, if you make money through mining, staking, interest, or airdrops and hard drops, those types of income are subject to ordinary income taxes. And also, when you sell something after holding it for less than 12 months, those trades are called short-term capital gains. So short-term capital gains, mining income, staking, interest, wages, those are subject to ordinary income taxes. And when you sell something, a coin, after holding it for more than 12 months, those gains are subject to long-term capital gain tax rates. And that distinction is super important, because long-term capital gain tax rates are better for you, because look at the comparison. The highest long-term capital gain tax rate is 20%, and the highest short-term capital gain tax rate is 37%, and it's actually expected to go up to 39.6%. If this proposal by Biden passes. So the TLDR here is that if you really need cash, make sure you sell the coins for which you held for more than 12 months. And this is another question that we get all the time, because crypto and blockchain is an ecosystem where it's built on decentralization. There's no centralized agency. So the common question that you might have is how the IRS know whether you have crypto. So these are the 4 ways that the IRS knows that you have crypto. If you're dealing with a centralized exchange like Coinbase or Binance US, and if you're getting any of these tax forms, it could be 1099K, 1099B, or 1099 interest, that means that information has already been reported to the IRS by the exchange. So this is the primary way that the IRS know that you have some crypto activity. So the point here is that if you get any of those tax forms, make sure you report them correctly. Because if you don't report those tax forms, IRS is going to send you a letter asking, hey, this exchange reported us you had this much of activity, but when you file the return, you didn't have anything. So what's the reason? So so number one, if you have a tax form, if you receive a tax form from anybody, that means that information has already reported to the IRS. Number 2 is through subpoenas. There could be some exchanges that are not issuing these tax forms, but they could get subpoenaed. And as a result, they could be required to release user information. And this is somewhat common in the crypto space. In 2017, Coinbase gets subpoenaed, and recently, I think last month, Poloniex, and I think it's Kraken. There were two exchanges that got subpoenaed, and if any of your names got leaked through one of those subpoenas, IRS knows your entire crypto activity. And number three is through the question that we went through a few slides ago. When you answer yes for that question, and by the way, you're required to, you cannot lie on that question because you're filing and signing the return under penalty and perjury. When you answer that question, IRS knows that this person has something to do with crypto. And then lastly, IRS uses these blockchain analytics tools like chain analysis and CipherTrace that can track your blockchain and transfers and those type of activity and match online and digital wallets into real world identities. So these are the 4 ways that the IRS knows you have crypto. The point that I'm trying to make here is that there's a lot of misconception going on right now that the central IRS and those type of regulators, they don't know crypto because crypto is anonymous or pseudo-anonymous. That's not the case, unfortunately. IRS latest crackdown. So in January 2021, IRS said that they are deploying this thing called Operation Hidden Treasure to specifically catch crypto tax sheets. So again, the point here is that this is not the time to evade taxes or do or play cat and mouse game, because IRS has deployed resources. They have educated the taxpayers. They have put that question on the top of Form 1040. So it's hard for you to say, oh, I didn't know I had to report crypto. So make sure you report things right. So you don't have to get into trouble in the future. So this slide, I'm not going to go through all of these, but this is like a good summary slide that explains the tax implications for different participants and different activities that we see. We went through kind of investors. These are the, most of the people in this space, are investors. So they have typically capital gains and capital losses. Then you have miners. We spoke about, how mining, airdrops and forks and compensation type of income could be subject to your regular income tax, just like your W-2 wages and etc. So, okay, getting paid in crypto. So this is important too, because we're seeing a lot of crypto-related startups are, raising, so much money, lately. And even before that, if you work for a crypto startup, you have an option to get paid in crypto. One thing to note here is that when you get those tokens, that creates a taxable event, and that token value is considered your regular, wage income. So you still got to pay taxes. Whether you're a W-2 or 1099 person, it doesn't really matter. You got to pay taxes at the time you receive them. And the key here is that you just have to keep good records of these tokens and the value at the time you receive it, because you pay taxes based on the value at the time you receive it. And also you got to keep good records for 7 years. IRS tax letter. So I don't remember if you guys have how thoroughly you guys have been following this space. For the past couple of years, IRS has been sending these different tax letters to kind of educate taxpayers / kind of as a scare tactic. So these letters came out in 3 variations: letter 6173, 6174A, and 6174. So these letters, I mean, if you ever get one, it's likely that you're going to get one, and sometimes you get it just because your name maybe got released through one of those subpoenas issued to an exchange that you use, and sometimes you get these letters because you didn't report anything. So if you get a letter, it's gonna be scary if you haven't seen these letters before. And I'll share access to this presentation. So if you click these links, you can see exactly how these letters look like. Usually these letters show, hey, you owe us, I don't know, millions or $2 million in underpaid taxes. Sometimes those are right, but most of the times those are not right. So if you ever get one of these letters, don't panic. We actually wrote like a full guide on how to respond to these letters and how to prove your case. So if you click the IRS crypto letter guide, you can see an in-depth analysis of how we help some of our clients, what needs to be attached to that letter to prove the IRS that, hey, this was a mistake. And IRS does make mistakes, because IRS is also learning about this space and calculating capital gains and capital losses. So it's likely that if you get a letter, it's going to have a big balance due, but just don't panic. Just make sure you know what you heard from this presentation. So there was an interesting case. So this was a situation where he was a college student at the time. He traded some Bitcoins, and after like 3-4 years later, IRS sent him a bill saying that, hey, you owe us $300,000 in a tax bill. And he was a college student and he never made 300,000 to begin with. So he followed that guide, and we actually helped him through CoinTracker to and he ended up paying nothing actually. So the point is that if you're in the crypto space, it's likely that you're going to come across any of those letters, even if you're doing everything correctly. Just don't panic. Reach out to us later. The statute of limitation. So this is, if you ask me what's the most important slide out of this entire deck, I would point you to this. And this is something that a lot of people don't know about. So statute of limitation is this legal concept that gives the IRS the formal authority to come and audit you. So generally speaking, after you file a tax return, IRS can only come after you for the next 3 years. After that, they don't have any official authority to come after you. Now, when you file the return, and if you substantially understated your income, meaning if you understated your income by more than 25%, IRS can come after you for the next 6 years after you file the return. But if you never file a tax return or crypto tax filings, they can come after you forever because you never filed it. So you never started that 3-year regular statute of limitation. So this is why we always stress that filing something is better than nothing, because as soon as you file a tax return, you start that 3-year statute of limitation. You give the IRS the least amount of time possible to come and audit you. And after 3 years, they cannot do anything unless it is fraudulent, because if it's fraudulent, then they can come after you forever. Or if you understated your income by more than 25%. So the filing taxes specifically related to crypto is extremely important. Tax planning. So this is the section of the presentation where I'm going to go over some tax saving strategies that you guys can follow to save money. Tax saving strategies, basically fall under 3 things. Either you can eliminate your taxes, which is great, or you can reduce your taxes, or you can defer your taxes into future years where your taxable income and rates are lower, so you end up paying less taxes. So let's go through some of these strategies. Number 1, just know that, again, this is something a lot of people don't know either. There's a 0% long-term capital gain tax rate in the US. So just to want to kind of give you a quick refresher, long-term capital gains occur when you sell something after holding that coin for more than 12 months. And if you have long-term capital gains, you say that you're married, you can cash out up to $80,000 worth of long-term capital gains in any given year and pay 0 income tax. And that chart is actually on the presentation. So, and if you're single, you can cash out up to $40,000 worth of long-term capital gains and pay 0 taxes. So something to keep in mind. This could be useful to you in a situation where I say that you want to take 1 year off from work. So, and then you can cash out long-term capital gains up to 80,000 and pay 0 tax. Essentially, it's almost like making 110 with taxes. So something to keep in mind when you plan your career. The other thing you can do is tax loss harvesting. As you guys know, crypto market is very volatile. It goes up through ups and downs. Essentially, tax loss harvesting is when you have your portfolio and when the market value dips below the cost basis, what you can do is you can sell those losing positions, harvest that tax losses, and quickly get back into the same position with the expectation of going up. The point here is that those losses are good for taxes because those losses offset your crypto income, It offsets your stock and securities income, and sometimes it even offsets your W-2 and regular income. So something to do whenever your portfolio is in the red, and there's an example that you can follow as well. Another thing that you can do to save on taxes, and this is extremely powerful. This could only be done using like a very sophisticated crypto tax software tool like CoinTracker. So there are accounting methods that you can use to calculate capital gains and losses for tax purposes. So for example, FIFO stands for first in, first out. LIFO stands for like last in, first out, and HIFO stands for highest in, first out. So essentially, this accounting method tells the IRS which specific unit of crypto that you're selling to derive that capital gain or loss. And essentially, what you should always be doing for tax purposes is using HIFO, highest in, first out. When you sell the coin for which you paid the highest amount for, you're mathematically reducing the capital gain because the delta between the sales price and the cost basis is the least when you use HIFO. So in CoinTracker, with just a click of a button, you can kind of go through these different accounting methods and see what works best for you. But 99.9% of the time, HIFO leads to the least amount of taxes because it's just simple math. So, in order for you to do HIFO, you had to have all the records of, the coins, and this is an IRS requirement. All the records of coins, the dates that you acquired them, their unique identifier, the correct valuation, etc. So it's really hard to do it manually. It is possible, but extremely hard. Highly encourage you to use a tax software tool for that. Donating crypto is another great way to save on your tax bill. So this is really good because it gives you two benefits at once. So when you donate your crypto, first you get to write off that value from your tax return. And that write-off reduces your crypto income and also your non-crypto income, like W-2, business income, and etc. And the second benefit is that you get to bypass that entire capital gains that you would have had on that crypto if you cashed out and then give the proceeds to a charity. So these are really great way to kind of, you get to bypass capital gain taxes, but you get also write off as well. And you get to, also donate, money to your favorite charity for a good cause. Moving on to the next one, gas fees. Again, these have been an issue, especially in the ERC-20 environment, and also exchange, transaction fees as well. Just know that if you treat them correctly, if you classify them correctly, these do have tax benefits. Again, that's the reason why you should use like a professional tax software tool like CoinTracker. So we track these things correctly, and then you get the benefit. Even though I know paying fees suck, but at least there's some tax relief if you treat these things correctly. Self-directed crypto IRA is another great option. Essentially, these are special type of IRAs that are set with custodians. You can Google crypto self-directed IRAs. Essentially, you would trade your crypto inside these accounts, and you don't have to pay taxes now. You pay taxes at your retirement, depending on the type of self-directed IRA that you have. So I actually wrote like an in-depth article about it. So this entire presentation is linked. So if you get a hold of this presentation after the presentation, I would encourage you to go and read more into that. Another thing that you can do, specifically if you're doing mining, proof of work mining, which is expensive because you need to buy this, expensive software, expensive hardware every year. Just know that IRS has like so much benefits when you deal with equipment. Like for example, the section 179 of the IRS code, it allows you to write off up to $1 million worth of equipment. And there's other section that allows you to completely write off the entire cost of your equipment in the very first year that you put those equipment into service. So essentially, if you're running a proof of work mining operation, you barely pay any taxes because these write-offs essentially put your taxable income either close to zero or below zero. And again, that's taxable income. In the real world, you're actually making money, but you're making money, you're not paying taxes because of the benefits of these huge write-offs. Opportunity zone is another thing that you guys can try out. Again, this is one of those advanced tax saving strategies, mostly suited for whales. So let me give an example. So say that you got into Bitcoin like in, I don't know, 2012, 2013, and right now you're sitting on a humongous amount of wealth. So what you can do is you can cash out that, big capital gain, and within 180 days, you can transfer that capital gains into this, one of those opportunity zone funds. And if you were to keep that, capital gains in that fund for 5 years, you get a 10% discount on your capital gain taxes. If you keep that funds from, 2 extra years, you get another 5% discount. And if you were to keep that funds for 10 years, you get a tax deferral, and you get to eliminate the capital gain taxes on the fund side, not on the crypto side, but on the fund side. Again, this is somewhat technical, so I can do a presentation just on this topic. So if you're interested, just click the link, and that's going to show you more in-depth information. Another thing that you can do, again, this is one of those advanced strategies as well. In the US, there are some crypto derivatives that fall under this code section called 1256. Here, the advantage is that when you trade section 1256 derivatives, 60% of the gains are always subject to long-term capital gain taxes, irrespective of how long you hold it. And remember, the long-term capital gain tax rates are way better than short-term capital gain tax rates. Again, the benefit here is that typically in a stock or a crypto, like a coin scenario, to get that better long-term capital gain tax rate, you got to keep that coin for 12 months. But if you're dealing with section 1256 eligible crypto, you don't have to keep that coin for 12 months to get the long-term capital gain tax rates for at least 60%. And the 40% is subject to short-term capital gains. But again, there's benefit here if you trade the right derivatives. Okay, so those are some of the tax saving strategies. So again, I'll share the slide deck with you so you can go into those more information sections and kind of go through some of those things in detail. And I want to talk a little bit about CoinTracker. So what does CoinTracker do? It reconciles all your crypto transactions coming from wallets, exchanges, from ledger, blockchains, and etc. And it gives you the tax forms that you need. So you don't have to do all these calculations in Excel spreadsheet. And in most cases, if you're using multiple exchanges, it's virtually impossible to do these calculations manually. We support over 300 plus exchanges, 3,000 plus coins, and you can also share that with your accountant as well. And it's free up to 25 transactions, and we are directly integrated into Coinbase and a bunch of other exchanges as well. And if you're listening to this, we set this discount code for you guys. So if you purchase a CoinTracker subscription through this link, you're gonna get a 10% discount. And if you have any questions, you can also contact us. And yeah, some takeaways. So 3 takeaways, I guess. So make sure you calculate your crypto, gains, or losses, using a tool like CoinTracker. It's really hard to do these things manually, and make sure you file because of all the reasons I mentioned above. And number 2, taxes suck, I know, but there are certain ways, legal ways, that you can take advantage of the tax code. Remember those situations where I showed you, those situations help you eliminate, reduce, and defer taxes. And last but not least, file something to start the statute of limitation, which is the 3-year period, because you don't want to give the IRS unlimited time to come and audit you. Just give them the least amount of time as possible, which is 3 years, and after that, you're safe for that year. Yeah, I think with that, we can go to Q&A. If you guys have any Q&A, I'm happy to answer.
I think there are a few questions in the chat that people have been kind of throwing in.
Okay, let me go through chat. Okay. I had no idea about 3 and 4. I'm not sure which one you were referring to. Maybe the taxable events. Okay, so let me open up my slides in another screen so I can see your questions. Okay, so question, I think it's a comment. So I had no idea about 3 and 4. Yeah, I think you're referring to spending cryptocurrency that creates a taxable event. I think the fourth one was earning cryptocurrency through like wages, staking, and those type of income. That those do create taxable events as well. The other question is, if you're paid in Ethereum, is that a taxable event or not until you convert to USD or another coin type? So actually, we went through this, but I'm gonna tell this to you again. When you get paid in Ethereum, you get taxed at the time you receive it, based on the market value of the coin at the time you receive it. It doesn't matter whether you cash it out or not. The IRS tax you based on the market value at the time you receive it. Okay. All right. So next question. Okay, there's a suggestion about donations. Yeah. Okay. Does Contractor support crypto taxes for businesses? Yeah, it does. So we have an accounting center. You can connect to your business, wallet and Coinbase Commerce and etc. And it reconciles everything. It generates your income statement and the balance sheet. So the answer to your question is yes, the Contractor does support businesses. Okay, can you just repeat the last thing you said about the 3 years? Okay, I think you're referring to the statute of limitation. Maybe you joined a little bit late. So the statute of limitation is this legal concept that gives the IRS the formal authority to go audit, people's tax return. Something to keep in mind is that just because they're IRS doesn't mean that they have all the rights to do, things. They have to answer to the Congress. They're controlled by other agencies. So the 3-year statute of limitation means that when you file a return, IRS only has legal authority to come and audit you for the next 3 years. So that's why filing something is super important, because if you don't file it, you don't start the statute of limitation. So as soon as you file something, you start the statute of limitation, you only give the IRS 3 years. And if you don't file anything, IRS can come after you forever because you never started that 3-year statute of limitation. Great presentation. We'd love to see the recording. Yeah, we are recording it, so you will get it. Oh, actually, Chrissy, you answered that. Okay, there's some overlap of abilities between crypto accounting software like Gilded, Cryptio, and crypto tax software like CoinTracker. Would a business need both, do you think? It depends. I think this is, this accounting and tax compliance space in crypto is an emerging space. There are certain software that are good at certain industries and certain, handling certain transactions. There are other software, that are good at, other types of transactions. So it depends on your use case. But ideally, you want to have only one accounting system, right? Because there's no point of paying for 2 subscriptions, in my opinion. Okay, another question. If I buy $1,000 in Ethereum, exchange the $1,000 of DAI, and then sell that DAI into fiat, could you walk me through where the taxable events are exactly here? Sure. So event number 1 is you purchasing $1,000 worth of Ethereum, which is not a taxable event. You're sending Coinbase $1,000. You're receiving $1,000 worth of Ethereum into your wallet. That's not a taxable event. And then what you do is you're converting that $1,000 worth of Ethereum into DAI. If you're doing it right after you purchase that Ethereum, there's no gain or loss, right? Because that Ethereum didn't have a chance to go up or down in value. So in that case, that's not a taxable event either. And then converting DAI to fiat, it's not taxable because DAI is a stable coin. It doesn't change. The value is always, pegged like, 1 to 1. So these 3 transactions are not taxable because the reason here is because at the time you exchange Ethereum to DAI, you just did it right away based on what I'm seeing. And the Ethereum didn't have a chance to go up or down in price. If it did, then you would have a capital gain or loss.
I see. Thank you.
Yeah. Okay, other question. If you are paid in crypto and recognize the income, then the value goes up. Do you then pay capital gain on additional gains? Yes, so this is a situation where so you get paid in a crypto, obviously you got to pay income taxes based on the market value at the time you receive it, and then you have it in your wallet, and that coin goes up in value and you sell it at that higher price. So yeah, it does create a capital gain event because that coin went up in price, and sometimes it could go down as well. So yeah. I think those are the questions that we have, unless you guys have anything else.
Yeah, just wanted to reiterate again that the recording and slides will be sent out to everyone who registered on the email list, and also our Twitter and Facebook and everywhere that we promoted the event. Yeah.
Okay.
Fulvia has a question in the chat.
Yeah. How are taxes computed for airdrops? So airdrops are taxed at the time those coins, hit your wallet, pretty much based on the market value. What if the coins don't have market value yet? Make sure you have documentation to prove that that the coins didn't have any market value. So you would report zero income, and then when you later sell those coins, you would have a capital gains based on the difference between the sales price and zero because you didn't report any income. What about lending and borrowing? So it's complicated, but just to keep at a high level, lending cryptocurrency to a platform is not taxable event. I mean, usually when you lend something, you're getting interest income like BlockFi and stuff like that. So that interest income is taxable, which is one of the crypto taxable situation that we went through, I think around slide 3 or 4. And then borrowing money is not taxable either. But when you borrow something, you had to pay interest expense to a platform or somebody. And that actually could be a tax deduction as well, depending on how you use the proceeds of that loan. So if you use the proceeds for a business purpose, that interest expense is a deduction on your taxes. But if you just borrowing crypto and using it to go shopping, that interest expense is not deductible because it's a personal interest expense. Actually, we wrote like an in-depth guide on how borrowing and lending work. If you Google Bitcoin loan simple guide by Shehan CoinTracker or something, you will see like all the transactions. Next question: does CoinTracker integrate with general ledger software like Xero or QuickBooks? We don't have a direct integration, but you have the ability to download the CSVs and directly import that information into the QuickBooks or Xero. And a lot of business that they use is what they do is at the end of the year, they download the reports, they summarize it to just one journal entry, and they book that journal entry to QuickBooks or Xero. Do the CSVs that we give to the IRS contain transaction hashes or addresses? No, because those things are not required. What we produce is IRS form 8949, where we have to put the date you purchased the crypto, date sold, the number of units that you sold, the type of cryptocurrency, the purchase price, sales price, and the profit or loss. So those are the only information that you have to submit to the IRS. Do you support DeFi layer 2 solutions? Yes, I mean, it's still, there's so many DeFi platforms. So the most popular ones that we support are Uniswap, V1 and V2. And, we add integrations, but, we use this program called Canny. So we have over 400,000 users, they have all these requests and we prioritize based on the number of upvotes we get for certain features. So to answer your question, we do support layer 2 solutions, but I'm not sure exactly which one you're talking about. Okay, so this is from Chrissy. Oh, this is from David. So I use CoinTracker to import into TurboTax. It went very smoothly. Yeah, glad you got a really good experience with us. What is the single most useful advice that you would give to us tax filers that have interacted with many DeFi protocols? It's complicated, so that's something to keep in mind. I would say if you're using multiple DeFi protocols, there's absolutely no way that you can calculate your taxes manually. There's no way. So you have to use some type of software and rely on the software, keep good records, just do the best you can, because even some of these softwares, they cannot even figure out certain things because these are like so like new, and the data that we get isn't perfect either. But just doing the best you can could go a long way when it comes to dealing with the IRS. Okay, what if business deals exclusively in cryptocurrency and would like to have monthly understanding of its finances, not just at the end of the year? Do you think importing the CSV on a monthly basis would work smoothly? Yeah, so if you want to understand where your finances are on a monthly basis, on our UI, you can see the income items, you can see the balance sheet, you can see unrealized gains and unrealized losses. So yeah, you can use our accounting center product to achieve what you're trying to do. Yep, I think that's the last question. Yeah. By the way, maybe just one more thing. We are actually actively hiring, and we would, unfortunately, we don't have any female representation in our teammates, and so we are actively trying to get those numbers up. And if you guys are interested, just check CoinTracker careers. There's a bunch of openings, and we are growing. We would love to have you guys.
I think we're actually working with CoinTracker on our job board that will be going live in the near future. So excited to work with you guys there. But yeah, thanks so much, Shehan, for hosting this webinar. Super, super informative. Really, really fantastic.
Great. Thank you for having me, guys. I'll see you later.
Thank you so much. See you.